Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today what we're going over is how to manage your emotions in your investing. How to manage your emotions specifically in your dividend growth portfolio. That's my investing strategy. That's the investing strategy that I try to get you guys educated on, try to help you guys get started investing. And that's how I'm able to make these charts. That's how I'm able to make this 26 stock portfolio and get a successful investing track record, as you can see from this chart right here. But we're going to go over the top 10 reasons, and I'll go ahead and scroll through them as we go along, and I'll give you my main bullet points as to why these are my top 10, how they should relate to you as investing, and then this big bold sentence right here. This is super important. I mentioned this many times throughout my channel, okay? It is so important. Investing is 90% emotion and 10% head knowledge. You do not need to be smart. You do not need to be educated to be a good investor. You just have to be really disciplined, really dedicated, and most importantly, have a control over your own emotions. But this is going to be a fun one, guys. If you're new to the channel, if you're not familiar with me, I'd invite you to subscribe. You can watch me update these charts every single month, tracking my annual and monthly dividend income, as well as my portfolio value and my monthly YouTube income. These are the 25 companies that I currently own, and if you want to invest in these 25 companies for yourself, this is down below in the description, as well as a lot of other things to check out, like, for example, mentoring calls, Yada savings accounts, credit card referrals, and then, of course, and if you want to get signed up with the brokerage that I use, the one that you currently see in this video, we now have 58 people signed up. 58 people have signed up using this referral link, and that is incredible. So we're trying to get to 100, and if you sign up and deposit $100 to the platform, you get a $10 bill just for getting signed up. So go ahead and sign up for M1 Finance. That's absolutely free. They have some incredible features, and in my opinion, they're just the best brokerage out there. But thank you guys so much, and let's go ahead and get into reason number one. Understanding market cycles. So I want to go ahead and show you guys a chart here. I want to show you ticker symbol SPY. And the reason why I want to show you this is that this is the S&P 500 ETF. So this is the top 500 companies in the United States, and this is how they're tracked in this one single price right here, currently 370 bucks. Now I want you to look at this year chart, okay? When you look at this chart, if you would have began investing in the beginning of the year, in December, January, February, March, in the beginning of 2020 or the end of 2019, you would have had a massive downturn just into your couple first months of investing. The S&P 500 ETF was about $338 a share. And then for the next month or so, the next month or two, it downtrended horribly. So it went from 330 to 320 to 310 to 300 to 290 to 80 to 70 to 60, 50, 40. It went down all the way to about the 220s. So you're looking at a 30+% downturn. So I want to go ahead and give you an example. If you started investing with $10,000 in the beginning of 2020 and you got to the bottom here in March of 2020, you would probably only have around $7,000. Your emotions would be at a sky-high level because you would be watching your account go down hundreds or even thousands of dollars literally by the day. Now, in retrospect, I always say that it is never a good thing to sell during a downturn, and it is something that I never recommend, no matter what the market's doing, no matter what headlines are out there, and I'll show you the reason why. You see this. During its peak, the S&P 500 ETF was $338 a share. Fast forward after you get past this market downturn, and we break past new all-time highs. And even today, look at this, another new all-time high at 370. Got all your money back plus gains in return. If you would have started right here in the 330s and then you had that massive downturn and then you sold out somewhere around here during the bottom, look what would have happened. You would have got all your money back and then some. And this is just one more reason why you should understand market cycles. It is perfectly normal for the market to have uproars and then massive downturns. You just got to ride the wave up because the market will always go up in the long run. And in my opinion, the way that I always kind of describe it is about 80% of the time, you're just hand over fist making money in the stock market. And 20% of the time, you're losing massive amounts of money. But the good news is you will always make more than you will lose if you're investing the correct way, which is never selling in a downturn. Number two is to know what you own. In my 25 companies, I can give you a basic explanation of what every single one of these companies does. Now, for example, Broadcom, they are a tech company. They produce a lot of microchips as well as owning a lot of software products out there on the market. Realty Income and WP Carey, they're both real estate investment trusts. They own a lot of the properties that you see for things like Walgreens and manufacturing buildings and agriculture land. And then Southern Company, they provide a lot of the utility services for people out there. Visa, I'm sure a lot of people know Visa through debit cards and credit cards and mobile payments and stuff like that. But basically, if you know what you own, you're much less likely to get emotional because you know that no matter what this price reflects. So let's go ahead and look at Visa. It's a pretty volatile stock. I'll just give that example. I am confident in Visa. I know that no matter what happens over the course of these next 10 years with the economy, with the United States, I know that Visa is going to be successful. They have the business model, they have the management team, they have the financials to be successful over the course of these next 10 years. And if that's the case, if I know the company, if I believe it's going to be successful, then no matter what this price shows, it doesn't matter if it goes all the way back down here to the 130s or it goes sky high back into the mid 200s, I'm investing in this company no matter what. And so I know what I own. And I'll give you a perfect example, that one that everybody can relate to. One example I always like to give, for example, is that if you own Pepsi, okay? Pepsi is one that a lot of people see every single day. Now, you can see in the description a lot of different brands that they, well, the description isn't loading for some reason. But okay, a lot of the brands that Pepsi owns, just to name off a couple off the top of my head, Aunt Jemima pancake syrup, Doritos, Cheetos, Fritos, Grandma's cookies, Gatorade, Pepsi, Lay's chips, Quaker Oats, Funyuns, and so many other products that you know and see and buy every single day. And a lot of people don't even know all the brands that come along with Pepsi because they have so many dominant brands out there. But if you're talking about a company that is dominant in the food and beverage space, you're looking at a Pepsi. And basically the way I look at it is, do you drink Pepsi? Maybe. Do you drink Coca-Cola? Do you drink water? Do you eat chips? Do you eat other types of snack foods? These big brands like Coca-Cola and Pepsi, if you believe that you drink it, you like it, you've probably been drinking it your whole life, is it safe to say that a lot of other people drink these brands too? Okay, I think that's a safe bet. These companies have been around for decades and hundreds of years. Would it be safe to say that they're probably going to be around the next 10 years? I would say so. And that's the case to make that as these companies continue to grow, as the population around the globe grows, and these companies continue to get more profitable, these companies will thrive. And that is why, if you understand what you own, you know that no matter what happens in the economy, people are still going to drink Pepsi. If you lose your job, you might not go out and buy a new truck. You might not go out and buy a new flat screen TV, but you'll probably still drink Pepsi. You'll probably still drink Coke. And that's why I recommend owning stocks that you know, and you will be much less likely to sell out during a downturn, and you'll be able to manage your emotions at a much better level. Number 3, manage your risk tolerance, okay? When you own stocks, okay, it is very easy to get emotional when things turn down. Like I showed with the S&P 500, okay? We saw that it had about a 30% downturn. I'll show you a company that had a bigger downturn but is now very successful. A lot of people forget about what happened with this company in late 2018 when it was about $300 a share and it went all the way down to the 120s. You're looking at the stock price literally getting cut in half. If you were investing in this company at the peak, you would have had your money cut in half. A lot of people, because of their emotions, would not be able to stay invested in this company. Meanwhile, what they don't realize is that this is the most incredible buying opportunity that you might ever see with this company. If you could have bought this in the 120s, the 130s, 40s, 50s, or even anything below 200, you would basically tripled your money in about a year and a half. What an incredible uproar that this incredible company has, and that's why you should manage your risk tolerance. If you can't handle these stocks having 50% downturns, 60% downturns, and watching your net worth drop precipitously, I would not recommend owning stocks that are very volatile. Own stocks that have much lower beta, ones that during downturns, instead of the market going down 30%, this stock might only go down 20% or 25%. Having stocks that are less volatile, a lot of your older blue chip stocks like a Pepsi, a Coca-Cola, a Procter & Gamble usually are a lot less volatile than your traditional growth stocks. So that is why I would manage your risk tolerance. Also, just generally speaking, before we move on to another 4, just a little thing I'd like to mention, I'd probably recommend that don't really invest in margin. Don't invest in inside of leveraged funds or do any kind of options trading or anything like that. Manage your risk tolerance. And what I found with investing, at least in my experience, the less risk that I have in my portfolio, the more conservative I am. Not only does that mean I'm actually usually more profitable, but that means I'm much less emotional. So number 3 is a big one. Have your finances outside of the market in order. Now, what I mean by this is not having other investments. That doesn't mean, oh, okay, so I have my equities investments, I'm investing in the S&P, I'm investing in these dividend stocks. Okay, so you're saying I'd invest in bonds. That means you're saying I should invest in other things. That's not what I mean whatsoever. The other day I went over Dave Ramsey's 7 baby steps. And while I don't follow this plan specifically, I do keep a lot of the main bullet points alive with mine and my fiance's investing strategy. So he has a lot of recommendations between saving $1,000 for your starting emergency fund, paying down debt, and specifically number 3 is the one that I want to talk about. Once you have your debt taken in order and once you have that starter emergency fund, have 3 to 6 months in a fully funded emergency fund. So let's go back to this chart and let's look at the massive downturn we had at the beginning of the year. So right here is most likely when you would likely be losing your job if you had any kind of financial stress from the coronavirus. So if that's the case and you don't have any cash, if you don't have any savings on the side, more than likely you're going to have to tap into your investing portfolio. And if that's the case, that means that the shares that you're going to be selling are now being valued at 10, 20, 30, 40% less from what you could have sold them for just 30 days ago. So if that's the case, you're not getting nearly the amount of money worth of what you should have. And this is why it's always good to have a fully funded emergency fund before, the key word there, is before you start investing. And it is always good to keep some cash on the side. And if you have your finances managed outside of the market and they're in order and they are ready to go for all emergencies, then pretty much no matter what, you're probably a lot less likely to sell out on a downturn because, hey, you know that no matter what, even if this were to go to zero, which it's never going to happen. All right, it's not going to happen. But even if it were to go to $0, guess what? You still have an emergency fund. You're still doing okay. You'll always have your bills paid no matter what this portfolio does, even if it were to go down 95%. Next up, we have number 5. Consider keeping a small part of your position in cash. Now, there's different ways to do this. Now, one of the things that I can recommend during normal economic times when we have interest rates that are at not zero, you could, for example, own SHV. This is a short-term treasury ETF, and right now it's probably not the best thing to own because of zero interest rates. It yields basically zero. But if we go to funds here and we go to the categories and we click bonds and we click government, where's government? Or okay, first we click domestic, we click government, and then let's go ahead and click short term. These are the bonds that have a lot less share price fluctuation, but they do give you an okay yield. So they do go up by a couple percent, they do go down by a couple percent, but these bonds are much more steady than pretty much anything that you can own in the market out there. And these are usually about 1-year treasuries or lower. Now the yield that you're only going to get on this is about 1%. So it is not very much. This is something that you should not really consider as an investment. Honestly, I probably wouldn't even really recommend even owning this. What I would probably do is just keep it in your cash position. Now, for example, I'll give you an example of this, is you can turn on auto invest in M1 Finance. And that means when you have over $25, you can invest into the portfolio automatically. Now, what you can do is set a minimum cash balance. So I'm going to pretend like right now I'm going to change that. So what this does when I click update, until my portfolio has $10,000 in the cash balance, it will always keep at least $10,000 in cash. And if you want, if you don't have such a high number, if you want to set a lower target amount, you can do $100, for example. Always keep $100 on the side or whatever number you need to keep. Or another thing that you could do is just to turn this off, update, and just keep auto invest off, and this will just build up cash from your deposits, from your dividends, and you can slowly build a little smaller cash position on the side. And then if the market does downturn and it goes down to these 30% levels that we saw at the beginning of the year, you can invest when the market's at rock bottom prices. Next up, we have small hedges in your portfolio. Number 6 is something that I don't recommend, but it is something that you can consider if you have trouble managing your emotions. So for example, we have the S&P 500 right here, SPY. If you want to, as a hedge, you can own something like, for example, SPXS. Like I said, I don't really recommend this, but it is something that some people do, and it does help them a lot. So let's look at the year chart on this. This is a triple leveraged Dirixon Daily S&P 500 Bear ETF. Basically, in English, what that means, when the market tanks, this thing skyrockets. So for example, at the beginning of the year, this was about $10, $11 a share. During the peak of the coronavirus, during the market downturn, it went up to almost 30. So you're looking at this share price about 2.5 timesing in share price, maybe even tripling in the matter of a month. So if you have even 5% of this in your portfolio, it is going to skyrocket. 5% of this can now become 15% of your portfolio because it skyrocketed in the matter of 30 days. But that said, there's one problem to doing this. If you're doing this over the course of a long run, it is almost guaranteed to lose money. So I'm going to show you the 5-year chart of this. If you look at the 5-year chart, it is massively underperformed, and it will always go down when you're looking at these leverage bear ETFs. They will always, 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 always go down in the long run. The only thing that they're good for is during crashes. And when you have crashes, that's great. But during the 80% of the other time when the stock market's going up, these will constantly lose money. And in my opinion, they're usually not worth it. But it's something you consider in making a small hedge in your portfolio. And there's other options for small hedges as well. I won't really go through them because I don't really recommend number 6, but it is an option if you want to explore that. Number 7, own corporate bonds and treasury bonds to lower your portfolio beta. Now, what portfolio beta means is having lower volatility in your portfolio. Let's go ahead and look at the pie preview for my portfolio. So when you guys load up my portfolio, this is the screen that you guys will see. So if you check out the description down below and you check out my portfolio, if you want to invest in yourself or just check out the holdings that I currently have, this is what you will see. And you see that my portfolio is not as volatile as the market. It's close, but it has a lower beta. And that's because right now I don't have any treasury bonds or corporate bonds, but normally, during normal economic times, I would. Now, if you have corporate bonds and treasury bonds in your portfolio, they provide a little bit of a hedge because they have a lower beta, meaning they're less volatile. So for example, if we look at things like LQD, LQD is a corporate bond ETF, one of the largest on earth, and this does not have as big of a gyrating stock price as the S&P 500 does. It looks like a massive drop because this thing is so steady, but on a percentage basis, it actually dropped less than the S&P 500. I know it looks like a big spike down, but on a percentage basis, it's actually less. So don't let that little chart trick you. So when you look at this, there's other options as well. There's other things like, for example, a 30-year treasury bond ETF. During a lot of recessions, this actually goes up. So if you look at the 5-year chart at the beginning of 2020, during the peak of the coronavirus, this actually went up and has actually been up trading for about the last 2 years or so. So these are the type of opportunities that you can add into your portfolio that gives you some opportunity to create a little bit of a hedge and, more importantly, lower your portfolio beta and give you a chance to have a portfolio that's a little bit less volatile than that of the traditional market. Now, number 8, what I would do is to seek guaranteed returns. Now, the 3 things that I recommended was debt repayments, interest, and dividends. Now, I will give you 2 examples of guaranteed returns. And the first one is, we're going to go back to Dave Ramsey's plane here, and that is to pay off debt. I don't care what the interest rate is of it. I don't care if it's 5%. I don't care if it's 25%. When you pay down debt, you're guaranteeing yourself a return. So let's say, for example, you have a personal loan that's 10%, and you're just paying off that loan payment by payment. If you pay that down early, you are guaranteeing yourself a 10% return no matter what, because that is 10% annual interest that you are avoiding having to pay to a bank or a credit lender or whatever that is. When you pay down debt, that is a guaranteed mathematical return. And I want to show you one more guaranteed return. Now, the reason I say this is guaranteed, let's go back here to EDV. This is a 30-year treasury bond ETF, a 20 to 30-year treasury bond ETF. Now, the reason I say this is guaranteed is that if the United States were to default on these treasury bonds, the United States would literally collapse on itself. And if the treasury bond were to collapse and the United States government were to lose its existence, if it were to just vanish into thin air, it wouldn't matter if you're investing. If you're just an average person with $100 in your pocket and working a 9-to-5 job and you have $0 in the stock market, you are screwed, just like every single other person out there. So sorry to say it, but if you're owning these, they are guaranteed returns. They just are. The only risk here is that if the United States vanishes as a country, and if you believe that that's not going to happen, these are guaranteed interest payments. So those are 2 forms of guaranteed interest payments. And last but not least, the last thing I can add it on here was dividends. Now, this is the only thing that's not, quote, guaranteed, but I want to give you an example. Here, I'll give you one other dividend aristocrat, or actually dividend king, that I own that a lot of people know. This is the largest healthcare company on planet Earth. This is Johnson & Johnson. They make a lot of basic things like Tylenol and Listerine and Star Wars Band-Aids, like I always give the funny example of. Or even things all the way high up to like $100,000 cancer treatments and a lot of expensive medical equipment. If it involves healthcare, if it involves your personal health, Johnson & Johnson probably has a footholding in it. Now, when we look at Johnson & Johnson, this is a company that has grown its earnings, its profits, for 36 years in a row. 36 years. And it has also raised its dividends 58 years. 58 years in a row, it has continually raised its dividend. I'll give you another example. I believe that streak is 62 with 3M. I could be wrong. They're due for another dividend raise in year in 2020. But this company has raised its dividend every single year for over 60 years. I'm sure 90% of you watching this video are under the age of 60. It's been raising its dividend longer than you've been alive. I'm 21 years old. It has been raising its dividend 3 times longer than I've been on planet Earth. That is a crazy thought to think about. And when you look at these companies, they're not guaranteed. I cannot guarantee that they will keep their dividend. I cannot guarantee that they will raise their dividend. But basically, how safe and stable a lot of these big companies are is that when you invest in them, there is about a 99% chance that they will keep their dividends or reinstate them at some point. So that is some form of a guaranteed return when you're looking at dividends, when you're investing in blue chip stocks like I am. Number 9, selling in a downturn is always a bad move. Now, real quick, I just want to flash just a little chart real quick one more time. You notice how I said if you were to invest, here, let's look at the 2-year. I like that little view. You see how in 2018, there was a downturn. It went straight down. If you sold out, you would have missed out on the opportunity. Look at where my mouth is scrolling by. You would have got your money back and then some. Let's go back to 2018 when the trade war happened, okay? This is a $290 share ETF. It dropped to about $234 a share. And then if you sold out, look what happened. It went up and up and up and up until the beginning of 2020. And then let's go to the year chart. Once again, we're at the beginning of 2020. It's went up every single month since then, and then a massive downturn. If you sold out during this downturn, guess what's happened? The stock market, after that downturn, right at these levels down here, stock markets went up and all the way back to new all-time highs. And you would have missed out on not only the money that you had, but more money that are profits in the future, as well as your dividend payments that you receive from these companies. So number 9, I will never, ever, 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 ever tell you guys on my channel that I or you should be selling on a downturn. I will never on this channel ever recommend that. Number 10, last but not least, invest a set dollar amount and contribute no matter what. When we go to my activity feed here, I want to go to deposits only. When we go to deposits, where's it at? I'm blind. Okay, deposits only. You look at this pattern here. Every single Monday, $100, $100, $100, $100 on Monday, $100 on Monday. Every single Monday, $100 like clockwork. I don't care if the market's up. I don't care if the market's down. I don't care if it's sideways. I don't care if it's spinning in a freaking circle. I invest a set dollar amount every single week, every single month. And the reason why this is so key and why I like number 10 and why it's so important is that once you set that commitment that, hey, I tell myself, no matter what the market does, $100 is going in on Monday, that keeps you more invested. And no matter what happens, the way I look at it, the deposit that I put in tomorrow, the deposit that I put in on Monday, if the stock market goes up, then great, my investment made money. That's what I expect. But if the market goes down shortly after I make that deposit, well, that's great because next Monday I get to buy in at a cheaper price, and that's how you should look at this when you're investing. But thank you guys so much for watching. I really appreciate it. I invite you to subscribe if you're new, if you haven't subscribed to the channel already. But thank you guys so much for watching on the way in. Go ahead and subscribe down below and check out the things that I left down below as well as referrals to M1 Finance, your savings accounts, credit card referrals, and mentoring calls. But thank you guys so much, and I'll catch you guys next time.